Well, a story that we've been talking about this week, and to be fair, here at Milken, is that it pays to be in treasuries. Last year, investors pocketed nearly $900 billion in annual interest from U.S. government debt, double the average over the previous decade. And that is set to rise as just about all treasuries now carry yields of 4% or more. In March alone, the Treasury Department paid out about $89 billion in interest to debt holders, or roughly $2 million a minute. We're here with more on U.S. treasuries and really the financial markets overall. A great voice, Ann Walsh. She's managing partner of Guggenheim Partners and the chief investment officer of Guggenheim Partners Investment Management. Ann, nice to have you here and be talking with you.
Nice to see both of you.
You know, it's interesting if we think about where we were last year. People were concerned, right? Regional bankings, recession, where are we going? Higher rates, what's going on? And yet, here we are, and we're surviving, and there's actually enthusiasm. What does that tell you about kind of what is going on more broadly in the outlook?
So when we sat here last year, there were recessionary pressures in the system. Believe it or not, those recessionary pressures are still there. But there's been one big difference, and you talked about treasuries, and that's been the fiscal spending. It's really supported the economy in the U.S., even while the Fed has been tightening during the quantitative tightening process. And what you've seen is globally, other central banks tightening, but they didn't have the fiscal stimulus effect that we had, so they slowed down. Whereas we're still slowing, but at a slower trajectory than we would have anticipated last year when the Fed was very active in quantitative tightening.
How does that complicate what the Fed has to do? All right, fiscal spending, great growth. Jay Powell says, hey, guys, we're growing, but yet some of that velocity creates inflationary pressures.
Absolutely. And what we've seen is that in quantitative tightening in the U.S., the balance sheet has been reduced from $9 trillion down to about $7.4 trillion. But when you think about the fact that deficit spending has been to the tune of about $2 trillion in that same time frame, it's really been almost perfectly offset by fiscal deficit spending at this point. And that is inflationary, and it makes the Fed's job harder. It's two forces working against each other.
Has it made your job easier, at least in terms of finding opportunities to invest?
Well, absolutely. Yeah. With a resilient economy, and by the way, usually, periods where the Fed is on pause, which they are, and we do not see a rate hike, we are not in that camp, that's a very good time for credit, for fixed income investments, particularly investment-grade fixed income, and also for risk generally.
I have to ask you, though, about the health of the market, particularly the Treasury market. Lisa Cook over at the Fed, she was just speaking a little while ago, talking about she had some concerns about Treasury market liquidity. And this has been a conversation that's come up before. I guess for you, does it matter? And B, if there is a liquidity issue, how severe is it right now?
Well, liquidity is a concern, but I really don't see it as a short-term issue. Right now, there's plenty of liquidity in the system. If we think perhaps more big picture, since quantitative tightening started globally, $5 trillion has come out of the system. But when you think of that in context of where we were pre-COVID and how much has come in since the COVID quantitative easing that occurred and the stimulus, that was $12 trillion. That means there's still an extra $7 trillion out there that still has room to, move. We have a lot of flexibility.
I do wonder, too, though, about with the fiscal spending that has also come in. Does that heighten the possibility of the Fed making a misstep in trying to deal with that and try to explain what's going on?
Well, I think there's a lot of skew in the numbers.
Yeah.
And what's really seemed to have happened is that the timeline has extended. So normally you'd expect in prior cycles we've seen where the Fed starts tightening, they start to slow the economy, we get recessionary pressures, recession happens, and then ultimately inflation comes down. This timeline has extended quite a bit. We've seen that we've been inverted on the yield curve for 22 months approximately. We've seen leading.
It's amazing.
It's amazing.
I forgot all about that.
Unprecedented, and that's tight in its own effect. But because again the fiscal stimulus has offset it, we haven't seen that impact. But as I said, the recessionary pressures are there. Leading economic index peaked about 22 months ago as well.
Yeah. So one question though,
go.
You have particularly about the yield curve, because I actually kind of forgot. I remember we
stopped talking about it.
But I mean, how reliable are these sort of, I guess, traditional historical signals that we always look to see when times are rough? Because a lot of those signals have been saying times are rough, even though it looks like times have been pretty good.
And it's different this time around.
Right. Well, it's really just extended. I think what we're seeing is just an extended timeline, relatively speaking. I do not think it's different this time, but there are different elements, and those have to be factored in. And when we sat here last year, we really weren't aware of those. We have what we're in I want to call it a COVID echo, which is we still have spending out there that's been authorized by the government, but yet hasn't been actually, sent out into the system. So we're going to still have more fiscal stimulus, for a while. And so that's why I just say the timelines are extended. But I don't think the cycle is dead. I don't think this time is going to be completely different, just longer.
So what should investors be doing right now? Like, what should they be setting up for maybe 6 to 12 months from now?
Well, I think ultimately by the time we get to the end of this year, some of that fiscal stimulus will be less. And as a result, it's a good time to be thoughtful with regard to risk positions. We think being, defensive, if you will, in credit. So that's investment grade credit, great trade right now. Also, parts of the high yield market, particularly the higher credit quality part. I'd avoid the lesser credits. We still have some risk, being rationed at CCC rated credit that I'd be thoughtful about. And you could see some spread widening there. But historically, when the Fed's on pause, this is a good time for credit.
I have to ask you about geopolitics, and particularly with the election cycle coming up. Does an election cycle at all change how you operate in the months surrounding the election?
It doesn't really. Markets do a bad job generally of pricing in geopolitical events, and that includes the U.S. elections. But on the other hand, I think that being thoughtful about the amount of volatility that could be introduced into the system as we go through the year, that's going to be an important element. And it's always a question when you do have the Fed tightening. You have to think about idiosyncratic risk, and so you have to be thoughtful more broadly about that generally. And that's just one other element.
What's the big risk on your radar that you're really keeping an eye on?
I think the big risk is always a surprise. We don't see one, but there is one element, and that's commercial real estate, and particularly office properties, that right now is not a really surprise. It's just an unfolding storyline. And I think it's going to be an unfolding storyline for the next several years.
Well, do you think as we kind of hit the loans that have to be refinanced and reworked, right? We're hearing a lot of conversations about it. They really go next year, the year after. Is that when we start to see some of the problems work their way through?
Yes, there's about $1 trillion of commercial real estate that has to be refinanced. And as those maturities arise, we're seeing more and more what I call, maturity defaults.
Right.
You don't have a sign that they're going to default necessarily because they're paying interest and principal along the way, right up until the time of maturity. That's what we're seeing, and it's going to take a while to unfold.
Just 20 seconds. Will it be manageable, do you think, in terms of the markets, or is it a mini crisis, a big crisis?
I think it's an evolving, backstory.
Yeah.
I think the markets are going to be fine, but I think small banks, regional banks are at risk, and I do believe that the commercial real estate cycle is going to continue for the next 2 or 3 years.
Great stuff. Ann, thank you so much. Ann Walsh of Guggenheim Partners. So appreciate it.